Let's get some insights on the news that's shaping the markets. And for that, we welcome in Jay Hatfield, founder, CEO, and portfolio manager at Infrastructure Capital Advisors. Jay, good morning. Thanks so much for being here.
Good morning, Caroline. Thanks for having me on.
So Jay, I want to kick things off by getting your take on the latest CPI report. Of course, 1 month doesn't make a trend, but we are seeing signs of at least slightly easing inflation. Key takeaway for you, does it change anything?
Well, Caroline, I think it really does. We had been optimistic that inflation would start to cool off in the fall, but we were very concerned about the lags. In particular, there's two categories where there's a big lag, and that is shelter and services. And we actually saw those decline already. So we read this as very bullish and makes it more likely that the Fed won't commit a policy error like they have a tendency to in the past, because they look at lagging indicators when they should be looking really at leading indicators like the money supply, which has declined 15%, which is the fastest since World War II. So we're bullish about inflation because of the money supply decline, and surprised that it happened so quickly. So that's quite bullish for the markets.
So you're more confident that the Fed won't commit a policy error, but can it take its foot off the gas a little bit for the September meeting and maybe not hike by 75? What do you think? Maybe more like 50 now?
It's always hard to predict what semi-irrational groups of people do, but because again, they tend to focus on backward-looking indicators. But certainly, if they recognize the lags that occur in monetary policy, 50 is much more likely, and then 25, and then they halt, which our analysis shows that would not create a recession in the United States. And that's why we've been pretty constructive about equities, particularly going into earnings season.
So let's talk about equities. Very short term, just in terms of today, we're seeing stocks really rally higher. Do investors have it right today?
We think so. You do have PPI tomorrow, and we were more optimistic about PPI printing, a good number, because that's a leading indicator for CPI. So we think that's positive. The only caveat, our target is 4,600 on the S&P, driven by the current level of interest rates and a modest haircut to 2023 earnings. We're estimating 235. So we're constructive. The only caveat is after PPI, you have a news dearth, which oftentimes gives rise to the bears taking control, just like they did in June. I don't think we'll go down as low as we did in June, but just beware seasonally, it's not a great time for the market, and there's not a lot of information flow. And so fears tend to rise. Good news comes from companies, and bad news comes from politics and economics. So just with that caveat, we're still bullish, but just be a little bit cautious given the calendar.
So the S&P is currently around 4,200. Your price target for your end is 4,600, so about 10% more upside from here, despite what could be some nearer term negativity. But what gets us to 4,600?
Well, it's important to note that would be about 19 times earnings, but you should never really quote earnings multiples without looking at interest rates. So right now the 10 years right around 280. And that implies that 19 times earnings. We are being a little bit conservative, so we're not using 245 as the current estimate for 2023. We've haircut that a little bit down to 235. So if you take those two inputs, the 10-year earnings estimate, and then assume a normal risk premium, that gets you to 4,600. And we are pretty bullish about earnings in the United States, particularly. What most investors have ignored is our huge energy cost advantage, which is causing energy, not just energy, but also materials, metals, chemicals, to be close to a boom. And that's driving strong employment and strong GDP.
So how and where do you guide investors in this space?
Well, to the extent that investors have taken cash off the table in response to, which is rational, by the way, response to tight monetary policy, we think it's better to, rather than going after the riskiest meme stocks, crypto, profitless tech, It's better to be more conservative. Go with, if you really want to be conservative, go with preferred stocks because they're senior to common and have good yields, or defensive dividend stocks, particularly large cap dividend stocks in more defensive sectors. And then if you want to take a little bit more risk, you could go after the more conservative, reasonably priced mega cap tech. But we wouldn't go all in on risk today. As I mentioned, it's important to be cautious that the Fed is going to probably be pretty hawkish because they want to tamp down expectations. And if they do that when earnings are not being reported, that could cause weakness. But when you have dividend stocks, you get paid to wait and you could reinvest your dividends at lower levels if there is a little bit of pullback. So you're in a much better position than taking a flyer on some of these momentum type stocks that were in a bubble during the pandemic.
So Jay, what is the biggest risk to the market right now?
It's really the Fed. As I mentioned, the Fed are mostly Keynesians. Look at the labor market, which is great, and everybody should look at the labor market, but they completely ignore the money supply, which is the best leading indicator. And they've really done what they needed to do. Through open market operations, they reduced the money supply by 15%. We think most of quantitative tightening, therefore, is behind us. But the Fed doesn't seem to recognize this. It's almost like their third mandate is to be behind the curve, as they were with their transitory theory of inflation. So the Fed's the real issue, but that's why today's report is critical, because we got this improvement in services and housing, which should have taken longer to be reflected.
So not a lot of confidence in the Fed, but I'd say with 4,600 price target, some confidence in the market. We have to leave it there. Jay Hatfield, Infrastructure Capital Advisors, thanks so much for being here.
Thanks, Caroline.